I always say that investing is 90% mental discipline and 10% valuation. I get asked all the time, can you please teach me how to value a company? Can you show me how you find and you value a stock? And those things are very important. But the most important part about investing, and the only thing that ChatGPT cannot do for you, is mental discipline, is being disciplined if your stock is flat for a year or 2 years while the S&P and all your friends and everyone else is making money. Or if your stock is going down 20, 30, 40% and you are not being influenced by the market and sticking with your long-term thesis around the company. Those things are much harder than trying to value a stock and do a research on the company. Anyone can do that, but the other things are much harder to do. So in this video, I'm going to give you 3 simple tricks that I believe could help you in this area. And those are tricks that I use throughout the years. And I really hope you enjoy it as always. And if you do enjoy it, all I'm asking is please press the like button and let me know what you think in the comments. Now, the first one, which is something that I talk about for the first time on YouTube channel, and this is a challenge that I would call the 3X challenge. The 3X challenge is a challenge that I took on when I first started investing. I noticed that I was looking at stocks all the time, like all day pretty much. And back then we didn't have overnight trading like we have right now. Now you have 24 hours trading and you have posts on X about Bitcoin being down whatever at 3 or 4 a.m. or some stock like Amazon down 2% overnight or 0.5% overnight, and people looking for a reason why the stock is down 0.5% or 1%. And you have the tendency to look at your stocks all the time. So I had a challenge, and the challenge was that I can only look at my stocks 3 times per day. One time around the open, so 9:35 a.m. Eastern time, around noon, so around lunchtime, 12 to 1 p.m., and around the close, 3:30 to 4 p.m. This is normally when the big moves tend to happen on the open, during the day, and at the close. Now, I only limit it to 3 times. Now, that might sound very simple, but if you actually try to do it, you will understand how addicted you are to the stock market. And you will understand why stocks like Robinhood are up 450% over the last year. This is because of you and me and most of us as investors, because we cannot sometimes control the tendency to trade unnecessarily in our stocks. Companies like Robinhood and other brokers right now, they don't collect commissions. They collect something called payment for order flow. So the more you trade, the more money they make. They want you to trade. They want to entice you to look at your stocks and to make a move as much and as often as possible. And your job as an investor is to resist this tendency as much as possible and to not fall into this trap and give them your money and make them rich. And this is the stocks that I own, by the way. And I'm saying this because this is the truth. And this is why the holding period, the average holding period of stocks in the United States have decreased to only 5.5 months. They were 5 years in 1977. Now they're only 5.5 months. 5.5 months is nothing, guys, and it's going down more and more. It's not even 2 quarters. It's not even full quarters of earnings. So if you miss on 1 quarter, you would freak out and sell the stock because it went down, or maybe in 2 quarters. This is absolutely crazy. Some stocks, they take years and years to play out. Berkshire Hathaway was flat for 7 years before it became one of the best performing stocks of all time. Microsoft was flat for 16 years, from 2000 to 2016. And now most of us, we can't even hold for a stock for 3 or 4 or 5 months because it hasn't moved or because the stock went down or something has changed. This is really not good at all. And that's what happened due to a lot of the things that people cannot control, looking at their portfolios all the time. And again, you could try to challenge the 3X challenge. You can only look at it 3 times per day, and you will notice how hard it is to implement. And after you implement it, you will notice how emotionally detached you are from your stocks. You will no longer care about the chart. You will mostly care about the quarterly earnings reports and about the numbers, because at the end of the day, you own a piece of a business and you don't own a chart that's going up and down all day. And Warren Buffett said himself, he said, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. And this is something that's good to remember. So maybe you can try the 3X challenge and you could let me know If it's difficult, I believe it's going to be difficult, especially right now with 24 hours trading and all these kind of things. It's not going to be easy, but let me know how you do. The second one, which I believe is an important one that I see a lot of newer investors do, is they are constantly comparing their returns to other people. So I see, for example, some people this year, they're up like 20% or 21%, which almost doubles the S&P 500, but they're upset and they're depressed. I'm like, why? Because some guy on X is up 80%. And I always tell other people, maybe he's up 80% this year, but if he was down, let's say 50% in 2022, you need 100% to make it back. So if he's taking a lot of risk in a bull market, it will work very well. But in a bear market, you could get killed and you could take years and years just to get back to break even. So when you see those returns, you never really get the full story. So you should never try to compare your return to others. We are each on our own in the market. We all invest the way it fits us best. It fits our personalities. Some of us are made to take on more risks. Some people are made to take on less risks. There's nothing wrong with that. And I always tell investors to go on this calculator called investors.gov, and you can put in the initial investment and put in your financial situation, and you could maybe put in a number for maybe the next 20 or 30 years, and then you can figure out what kind of rate of return do you need to get to your dream number. To some of you, it could only be 8%. To some of you, it could only be 15%. To some of you, it could be 25. To some of you, it could even be 35. My target based on my goal is 20 to 25% annual return. So I structured my strategy on delivering 20 to 25% annual return. I was able to exceed it with an average return of 34% over the last 5 years. But my goal, this is what I'm looking for, is 20 to 25%. So I'm not going to cry if someone's up 80%. I wish him the best. And if he's down 80% in the bear market, I'm not going to be down 80% in the bear market. But my goal is 20, 25%. To you, it could be 15. So stop trying to compare yourself to others and feeling bad that you're not the best. There's nothing such as the best in the market. There's always going to be someone better, and even in life in general. So being depressed over not being up more than someone else, if you're like outperforming the S&P by so much, is crazy. Like Warren Buffett's average return is 15%, guys. The average return of the S&P is, I believe, like 8 or 10%. So he really outperformed the S&P by 5% a year. So if you're outperforming the S&P by 10 or 15%, you're doing extremely, extremely well. And you're upset because someone else is up 80% on a crazy year. He got lucky or he bought options or something. To me, I would not be too depressed. And now such depression could actually lead you to take on a lot of risks that you normally wouldn't take. And that could cause you to ultimately lose more money in the long term. So this is a dangerous one. And I encourage you not to do that at all. The last one, which is also an important one, it's a psychological mistake, is trying to be perfect. So a lot of the newer investors, and we have a lot of newer members in the market, they have a lot of pride. So they don't want to take a loss. They always want to wait for break even. I don't know what is the obsession with that. So let's say they buy a stock, they realize they made a mistake. Maybe, the CEO steps down, or they just realize like something has changed, or they realize maybe they overpaid or something has happened. And let's say they're down even 1 or 2%. They say, okay, I'm going to wait until it hits zero or slightly positive, and then I sell the stock and move on. Well, what if the stock goes down 50% and never recovers? Not every stock is going to recover, guys. You can look at Walgreens. You can look at many of those stocks. Some stocks go down and never recover. So sometimes it makes sense to take a loss. Sometimes we all make mistakes. Warren Buffett makes mistakes. Warren Buffett took losses. Warren Buffett's hit rate, I believe, Monish Pabrai said it's like 4 out of 10. So 6 out of 10, he pretty much breaks even or he loses money. And 4 out of 10, he actually makes good money. And most of Warren Buffett's gains, they came from like 5 or 6 investments, Geico and the bank stocks and a few others. And a lot of them were actually losing bets, So if you think about it very well, you're going to have a lot of losing stocks in your investment life. There's no questions about it. You cannot escape it. You cannot prevent it. It has to happen. It happens to me. It happens to you. It happens to every single person. But the best thing you can do is try to cut it loose as quick as possible once it's small, instead of trying to wait on 2% to get to break even, which I see some people do. And then you can learn a lesson from it so you don't repeat it again. And you can see what I have done wrong, what did I do, and what can I do to not do it again. You could write some notes or do something, and then you can improve with it. But stop trying to be perfect, trying to be the guy that never wants to lose money or never wants to admit they're wrong or never wants to do whatever. We're all gonna lose money. No one's perfect. Sometimes you're gonna underperform the S&P. That's why the average return, let's say, of Buffett is 15% a year. Some years he had 40, 50%. Some years he had 2 or 3%. And over the last 10 years, Buffett has underperformed the S&P. So sometimes you're going to underperform, sometimes you're going to outperform. But if you're underperforming for a year or 2 years, that doesn't mean you're a bad investor. It doesn't mean you don't know how to pick stocks. It doesn't mean anything. It's just 1 or 2 years. And if you're investing for the next 20 years, then you still have time to make it up. And again, so stop comparing your returns to others and to the S&P 500 on a daily basis. This is something else that I see on the internet. So I see people on X and even in my own group. Let's say we buy stocks and then, the S&P is up 1%. Our portfolio is up, let's say 0.2%. Oh, we're underperforming the S&P today. What does that mean? I couldn't care less about the S&P, or I should care over a long enough time frame to know if what I'm doing is actually worth it in terms of an opportunity cost versus the index. And in my case, I pretty much killed the S&P 500's return with my 34% average return. But in general, it's a bad idea to compare yourself every day and every week and every month, because then you're going to try to do things to catch up to the S&P on a short-term basis, and then you're going to forget about your long-term thesis, and then the whole thing is going to be messed up. So those things are very important. The 3X challenge is not an easy one. If you could do it, especially now in 2025, you could be a legend. It's not easy for most people. Comparing yourself or your returns against others, it's a losing proposition, because you're never going to be the best. There's always going to be someone better, and you're going to forever live in that depression. So you just have to invest for your own financial goals. It could be 15%, could be 8%, could be 35, could be 25 or 50%. I don't know if you get 50%. So it's up to your own financial situation. To each one, it's different. And the last one is trying to be perfect. No one's perfect, and we're going to make mistakes. We're going to lose money, and we're going to learn from it and improve. This is how we improve. And I try to share more of such videos in my own investment group, and I share everything I do, all my picks and everything in real time. If you're interested, this is the link over here. But thank you again for watching me. Not financial advice. Hope you enjoyed it. Hope you learned something. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.